out there. But I think ultimately, the good news is that as disparate as these various challenges are that we're facing, I think it all boils down to the same kind of solution, which is just to be really good and focus on kind of helping customers and the buyers and sellers. I think really need us now more than ever. These are very challenging times for them, and I think that is how we overcome all of these various things that are happening. So I want to take just a little bit of time and talk about the macro economy, because as kind of distracting as all of these headlines are, the macro environment is really the thing that's driving the outcomes that we're seeing in housing right now. It's not something that's locally driven, right? This is mostly an interest rate driven show. And so it's not something that the Downey City Council is doing or anything like that. And as a result, we see that the kind of the market looks very similar no matter where you are in the state. So we want to just have a decent sense of where the economy is, what we expect economically, because that will play a big role in what happens to the housing market this year. And one of the reasons why we're actually a little bit more optimistic on housing this year is because we expect the economy to be a little bit slower. And we're in this kind of paradoxical time where a slower economy might actually be a positive for housing. And the reason that's the case is because the Fed is so hyper focused on inflation that the stronger the economy does, the harder it is to get over this kind of last mile on inflation. And so if the economy slows, and we think it will, mostly because consumer spending probably taken a step back, and that's been one of the main sources of growth since the end of the pandemic. And also to a certain extent, the commercial markets, although that's more of a kind of wild card, and we don't know if that's going to blow up yet or not. But regardless, we're expecting slower growth on the economic front, which may give the Fed a little bit more cover to lower the Fed funds rate and help the bond markets to get over this fear of inflation, and maybe see those bond prices rise a little bit and the bond rates come down. That may ultimately benefit us in housing, both on the demand side, because lower rates obviously help us purchase more home, but also I think more importantly on the supply side, because you've got so many would-be home sellers that are locked in to their current extremely low rate loans. And that's why if you look at what the macro data and the macro outlook suggests for housing, I think it means that last year was the low point for sales. This year should be a little bit better. We don't want to over celebrate, but I do think that we can kind of breathe a sigh of relief, in the sense that we probably survived the worst downturn in housing since the 2008 financial crisis. And I think, again, those low rates are going to help when it comes to getting more buyers. And we already saw that in January when rates went down into the low sixes. You had a lot of buyers come back into the market. Mortgage applications went up, pending sales went up. But I think more importantly, again, it's going to help to get some of those locked in homeowners that maybe aren't at those super low rates of 2.5%, 3%, but maybe in that 4%, 5%, 6% range, of which there's still a chunk of homeowners out there at those higher rates. And for those folks, it only takes a little bit of downward movement to get them moving again. And so inventory should pick up a little bit. And that's going to be, I think, the key to unlocking more transactions. I still don't think that there's going to be a major wave of distressed sales. And I still see buyers, in my opinion, sitting on the sidelines unnecessarily, waiting for rates to go down to 5%, which I don't think is going to happen. And I think one of our big tasks is to kind of bring folks back to reality that the decline in rates is going to be slow, and prices are going to continue to rise. And so this idea that waiting means saving a bunch of money, I think is doing folks a disservice. And we should be pointing at the data and suggesting that it's not 2008 all over again, and why even in a kind of worst case scenario for the economy, which again isn't what I'm forecasting, we still have growth, albeit a lot slower growth this year. But even in a worst case economy, we don't see that materializing into a bunch of foreclosures. And I think that it's important to talk through how the fundamentals are different and why ultimately that translates into prices that are going to be even higher next year. And so again, a lot of these high income, gainfully employed renters, I think, are sitting on the sidelines unnecessarily. And that's one of the opportunities I see, because even as rates are higher, and we should expect demand will continue to be depressed for the foreseeable future, because we're probably not going to get back to those 3% rates again, barring some kind of unforeseen catastrophe in the economy. And again, I think, we can unilaterally move the needle on buyer demand because we have so many of these gainfully employed renters just sitting on the sidelines, when the reality is they're probably not poised to save a bunch of money by waiting around on the sidelines. And so again, I think consumers need us more than ever. They need us to help clarify all these competing negative headlines that are out there. They need us transactionally, right? The RPA is like 4,000 pages long. We got insurance issues. We got a tight market, competitiveness, and all of that stuff. The other thing that makes me optimistic isn't just that the consumers need us more than ever. There are still segments of the market that are doing well. The top end continues to overperform. It's not doing as well as it did when rates were 3%, but it's still well above any of the pre-pandemic numbers that we saw in the kind of decade leading up to 2020. We have investors, people buying to hold and rent. We have flippers out there that are active again, because the buyers that we still have at these higher rates tend to be more picky, and that creates opportunities for people who want to come in and take some of these older units, fix them up, get them more camera ready. Those tend to be the ones that are doing better on the market today. And so even as the kind of repeat seller turned home buyer is probably going to stay depressed, because we have a lot of these folks locked in, there are these other segments of the market. First time buyers actually continue to rise as a share of the market. And even though it's hard to work with first time buyers because they, just inventory is so tight, you got to show them a million properties, submit a million offers before you finally get them into a closed transaction, but they're not weighed down by some of that baggage that the repeat seller has in terms of walking away from those low rates. They still want home ownership. They're not particularly scared off by 6.5% rates. They just need to find a unit that they like and can afford, and they're ready to move forward. So I think that's another smart segment to focus on, and one that also kind of has that feel-good piece of getting folks on that property ladder and towards that one and only path to wealth accumulation that's so well documented. Last thing I would say is that get active on the policy front, because we can really make a big difference with good policy right now, whether it be on building new supply, encouraging turnover by increasing the capital gains threshold, et cetera, building ADUs, you name it. There's a lot of ways where California's layered on a bunch of self-inflicted wounds policy-wise on top of this challenging macro environment. If we can undo some of these harmful policies, it could, again, really help to get those active listings back online and to help facilitate home ownership getting back on the upswing. And so I think the bottom line for the market this year, and then we'll look at some pictures together, is things should start to improve, but it's going to be a slow improvement. Rates will come down, inventory will pick up, that will lead to more sales, but it's not a pop the champagne corks kind of throw it in cruise control type of environment. And again, even as we have myriad challenges, from lawsuits to sexual harassment stuff to you name it, it all boils down to the same solution, which is to be that market expert, cleave to consumers, deliver on that value proposition of being a true expert and helping them navigate the most complex, largest financial transaction they'll ever do that is only getting more and more complicated by the day. I think, again, we need to be those evangelists for home ownership. We need to overcome that brother-in-law effect, where your brother-in-law says, just wait for 3% rates in the foreclosure crisis and save a bunch of money. That's just not going to happen. And that's where, again, I think we can have a big impact regardless of what the macro environment does, because you've got a lot of qualified buyers that are sitting on the sidelines on some myth that waiting makes good financial sense. So why do I think that the macro stuff is actually going to be a positive for housing this year? It mainly boils down to interest rates. And I think we're going to end up probably doing a little bit better on rates than what the Fed is currently broadcasting. But it's going to be a slow burn. I think a best case is like 150 basis points. And that's because even as we continue to make good progress on inflation, you can see on the blue line here that we've fallen from about 9% inflation a couple of years ago down to about 3% headline inflation. Now, we've made sustained and significant improvements, but the last mile on inflation is going to be the toughest to get rid of in the labor market shortage, which is really driving most of this last mile on inflation. And you saw, hopefully, in the January data that we added another 335,000 new jobs. The labor markets are just very tight, and that's driving more wage growth, and that's leading to price increases by suppliers, because when they're fighting over a limited supply of workers and paying to get these positions filled, they're ending up passing on those increased costs to consumers. And that's why even as inflation has come down, it's still about 50% higher than where the Fed wants it to be. They have a 2% inflation target. And this last bit of inflation is driven by very, very tight labor markets. So things are moving in the right direction, and they'll continue to do so, but it's going to take a while for this last bit to go away. And that means that we're probably looking at rates that are, again, going to be very slow to come down. And indeed, you can kind of see that in the bond markets, right? That the bond market loved the latest inflation number. They loved the Fed funds rate meeting in December, where the Fed said they were probably done raising rates. And we actually saw the 2-year and the 10-year Treasury fall from over 5% down, below 4% for a handful of days there. And the blue one is what really matters for 30-year fixed rate mortgages. This is the 10-year that translates almost directly into changes in the mortgage rate. And those have come down a lot, and why rates dropped from 8.25 down to about 6 2/3 last week. But if you look at the tail end of this chart, it kind of backs up this story that the inflation numbers and therefore the Fed funds rate are going to be slow to come down. Because if you look at the very right-hand side, we had about 110 basis point decline in the 10-year Treasury, but now those declines are kind of petering out, and we're hovering in that 4% range. And I think that's because even in a best case for the Fed of maybe 100 basis point reduction in the Fed funds rate, you could see that would bring this gray line down basically on top of the 10-year Treasury note. And that's kind of in a best case generous estimation of where the Fed's going to be, and why I think we shouldn't expect a rapid decline in rates. So, if you've been waiting around for lower rates, we already went from 8.25 to 6.5. Now is the time, because we may see them bounce back above 7. And in fact, I think on Friday they did go above 7 for a few hours. And so, again, I think this is where we can have an impact, but also why we should expect demand will be relatively lackluster, just because rates aren't going to plummet down to those levels that we were at. And again, if you see the 30-year fixed rate mortgage, it's following exactly what we see happening on the 10-year. It dropped from 8.25 down to about 6 2/3, but it's kind of hanging out in that range and may even begin to tick up, because you can see that the 10-year on a weekly basis is actually rising again, and I think poked above 4%. So rates are a lot higher than they were a few years ago, but they've also come down a bunch from where they were even a year ago. And so I think, again, bringing buyers back down to reality that a 6.5% rate is pretty much normal from a historical standpoint, and that we were just incredibly spoiled over the last couple of years by those very hyper low rates. So, I think there's an opportunity there again to kind of talk some of these buyers off the sidelines who think somehow we're magically going to be enjoying a 5% rate, when it seems like 6.5 is kind of that sweet spot, even if we get these Fed rate cuts that we're hoping for. And this has impacts on buyers and sellers. We kind of, naturally get the impacts to buyers that when rates go up, I can't qualify for as much mortgage, and therefore demand goes down at every single price point. But this is also really important for sellers to understand. I live in San Luis Obispo, and we have I was doing a forecast conference I guess it was like 2 months ago now in San Jose. Lawrence Yu, and the NAR chief economist, was there speaking as well, and he mentioned that one of his big projections for this year and the next couple of years is that, divorce rates are going to start falling because so many people are locked into these low rate loans. It's like, even if you hate your spouse, you love your mortgage, and you're going to like try and find a way to keep that thing going. I disagree to somebody who's recently divorced, but as a seller who is trying to sell in a market environment like this, it's really important to understand that at every single price point, you have fewer buyers available for your home. So like, in my specific case, we did get divorced and decided to try and sell the home. My ex goes on Zillow, thinks it's worth 1.2, which is problematic in and of itself. But also then, our realtor goes out and does a bunch of the comps and says, now I think it's really around like 990. So, I went through and ran the numbers, and it's like when rates were at 3%, to get roughly that million and change that my ex was hoping for, we needed about $180,000 a year household could buy that house at our, kind of desired purchase price, at a 3% rate to get that $5,200 a month payment that this $180,000 a year household was shooting for. We again, we're looking at about $180,000 a year household. What happened to that household is rates jumped up to 8%, which they did. We put our house on end of July, beginning of August of 23. And that was right as rates went from 6 to 8.25. Well, guess what? Now that same $180,000 household that I was banking on buying my house, right, when rates were at 3%, now qualifies for less than $300 or $700,000, right? 677 and change, essentially. And so our buyers took about a $400,000 hit to how much they qualified for. And so, my ex, when my realtor has it on for over a month and we get no offer, she calls and says, okay, I think we need to lower it from 990 down to 950. My ex was, kind of angry. She and I think you're going to run into a lot of these buyers that have expectations that were set based on a 3% rate environment, and you psychologically already got that money spent. She's like yelling at the realtor saying, we can't cut it by 50 grand. Like, I was going to buy my boyfriend a boat, and he deserves that boat. He's the best bartender in the world. He's going to get a boat. And if we reduce, I can't do it. But thinking through it through the lens of what happened to purchasing power, right? You can see that finding a buyer who can still take our house with a 50 grand reduction is almost lucky in some ways, because that same $180,000 a year house that we were hoping to buy before, comes nowhere close to that 950 purchase price. And that is important for those sellers to understand psychologically, so that if nothing else, save yourself from a bunch of angry voicemails from a seller that had unrealistic expectations, thinking that it was just going to fly off the shelf, because there are just fewer buyers. Indeed, if you work the math in reverse and say, okay, what kind of a buyer do we need in order to still meet that 1 million and change threshold at an 8% rate? You can see I'm not looking for an $180,000 a year income earner anymore. I'm looking for someone now that makes almost 300 grand, right? So it's like, almost in some ways doesn't matter. It's like your boyfriend can make the best cocktails in the world, but there's just not enough demand there at these rates to support the price necessarily that you want. So we've got to be a lot more strategic about where we're pricing these homes and make sure it's truly based on values, and that we're doing all of that market analysis. We also probably are going to want to coach sellers into doing more on the pre-listing side than we've been able to get away with up to this point. When rates were at 3% as a seller, you could, have terrible pictures. You didn't even need to clean the house. Forget staging it. Like, you didn't even need to pick up all your junk, right? And you could put it on and you'd still get multiple offers. Now we have buyers who are like, used to looking at, $1.1 million homes, right? They've got like $1.1 million tastes, but on a $700,000 budget, which is where all these flippers are coming from. And so again, I think it's key to make sure that sellers both have managed expectations, that we're strategic in how we price it, how we market it, how we show it, how we stage it, but also being a little bit more willing to spend money to make money, because we're competing as sellers now for those limited numbers of buyers in a way that we didn't have to over the last couple of years. And so I think it's all really important. And again, where I say they need us on the buy and the sell side more than ever, but therefore it's kind of incumbent on us. Otherwise, you got a bunch of people like my ex that are, angry that their boyfriend doesn't get the vote, thinking that their realtor isn't good at their job, when it's really just a function of market dynamics driven by this interest rate effect that we've just talked through. On the buy side, I'd be reminding folks that rates were up at 8.25 and fell down to 6.5. Like, you already made back 100 grand in purchasing power. You went from 670 to 770, right? So like, if you've been waiting around, now is the time. And again, I think this is where we can have an impact, and that's a story that's worth telling, and where regardless of what happens to the macro environment, we can be kind of optimistic, because this is the amount of home buyer demand that we're currently seeing, right? And I kind of joke about the brother-in-law effect suppressing demand, because when you look at these numbers, December and January were essentially at the lowest levels we've seen, even lower than they were during the 2008 financial crisis. And we just talked about how we should expect demand to be lower. Buyers don't qualify for as much as they did when rates were at 3%, but there's no reason that demand should be this low, right? If you think about these low numbers of mortgage purchase applications, we're seeing fewer folks apply to get houses now, even though unemployment nationwide in January was less than 4%. There's less people trying to buy homes now than there was when unemployment was 16%. We have fewer people trying to buy than there was when 1 out of 5 people in the United States, for all intents and purposes, didn't even have a job. And so we should expect demand to be low, but it shouldn't be this low. And I think this is where we can really move the needle by reminding folks that housing isn't a short run game. It's not about timing the market and buying low and selling high and perfectly timing things. It's about getting your foot on the property ladder in a house that you like and that you can afford right now. And if rates go down, God bless, refi, take advantage. But what you can't do is go back in time and accumulate equity and pay down principal on a house that you didn't own, right? And we need to remind folks that you're going to be paying a mortgage over the next 12 months regardless. The question is whether it's yours or your landlord's, right? And so again, I think we can boost demand by pointing out that rates are basically normal by historical standards. They're not going to fall a ton, and the outlook for foreclosures and price declines is minimal at best. And I think by that standard, the first best time to buy a home in California was like 20 years ago, but the second best time is still today, because it's still the one and only way that people accumulate wealth in this country. And with prices and rates not set to plummet, I think people are being led astray and doing themselves a disservice potentially, and demand shouldn't be as depressed as we're currently seeing in these numbers. We did 225,000 units in December, which is hopefully the low point for this cycle. But again, we shouldn't be selling fewer homes now than we did back in 2008 when nobody had a job, right? And so again, this is both our biggest challenge, but also I think the reason why we can be optimistic, because I think the needle has swung too far in the opposite direction. Again, when you look at it geographically, you don't see a lot of big trends or differentiating factors. This is driven by rates. And so when you look at the 23% decline in transactions last year, it was pretty consistent across the board. And that's true regardless of whether you were in, Lake Shasta or the Central Coast where I live, or the Bay Area with $2 million median prices, or in Southern California. That same 20 to 25% reduction was a function of this doubling of mortgage rates over the course of the last couple of years. Again, I pulled the local data for Downey. We didn't get that same spike in transactions that other areas did during the downturn, but you can still see 21 was a pretty good year for sales. And then as rates started to go up in 22 and 23, we dropped to the lowest levels that we've seen going back a number of years. But again, not a lot of variation from what you see statewide in terms of percentage changes. The biggest difference is that the top end is no longer exploding. It's funny, when you go back to the 3% rate environment when California was growing by like 20% in 2020 and then 11% again in 21, it wasn't because the low end of the market was shooting up. When rates were at 3%, we weren't selling a ton of $500,000 sales. In fact, the low end of the market doesn't look much different last year than it has the last 3 to 4 years. The big difference is that the top end of the market is no longer doubling. And that's what kind of those pessimists and naysayers really like to point out, right? Like when I went and bought my car a year ago, the guy in the finance department's like, "Oh my God, you're the chief economist at CAR." He goes, "You should see this email that my brother-in-law just sent me." He like turns around his computer screen and it was like pointing out how the top end of the market was in free fall. It was down 20-25%. But what his brother-in-law forgot to tell him was that they were up about 100% the year before that. And if sales go up 100% and then they shrink the next year by 25%, we're still 75% ahead of the game. So the top end is still doing well. We still have those high income earners punching above their weight economically. It's just not that explosive growth that we had when rates were at 3% and those kind of high income earners really leaned into and took advantage of those rates, buying bigger primary residences, second homes, vacation homes, stuff to buy in Airbnb, and all of that stuff. And indeed, if you look at the number of transactions over $1 million and you just strip out the bottom end of the market, you can see kind of that story that I'm telling you, right? Your brother-in-law is focused on the fact that we did, 90,000 sales over $1 million in 2021 and only 55,000 sales over $1 million last year. But forgets to tell you that we couldn't break 45,000 for the preceding decade leading up to it. So there were still 10,000 more sales at the top end of the market than there was before the pandemic. It just wasn't, double what it was before the pandemic. And so again, I think this is still an area of opportunity, a segment that's going to continue to do well. It's just not exploding through the roof in the way that it was, such that it was kind of offsetting declines under 500,000, which is really the story of the pandemic. Let's go ahead and finish your brother-in-law's analysis off once and for all. Why do I not think there's going to be a big foreclosure crisis? It's simple. It's supply and demand. And supply is going to be very, very tight. As terrible as the impact of higher rates was on home buyers, the impact to supply was even worse. This is the number of mortgages in California outstanding by current interest rate all the way through the end of last year. And if you zoom in on the most recent data, which is the only stuff that really matters, it's like, what's the current vintage of California mortgages? That's what I'm showing you here in this pie chart. This shows us that 68% of Californians have interest rates below 4%, right? So these are folks that face an extreme financial penalty for moving, and why Lawrence Yun from NAR said nobody's going to get divorced, right? Because there's just, even in my case, right? Like we're kind of committing financial suicide, because even if we could sell this house for $1 million, we'd have to go out and find 2 houses for 500,000. Not easy to do. Even if we are able to find 2 $500,000 homes instead of $1 million home, they're going to be a lot lower quality, right? They're not as nice as the $1 million house that we have right now. And to boot, it's probably going to cost us more than double what the current mortgage is on this house, because we're going to be financing 2 $500,000 homes at 6.5% instead of the $1 million that we have at 3%. Meaning that no one is really going to want to sell their house unless they have that metaphorical gun to their head the way that I do. But I still see this as an area of opportunity, because while there's 68% of folks below 4%, we still have about a third of the market that's above 4%, right? Including about 15% of folks with 5, 6, 7 plus. And for those folks, even modest declines in rates, which is what I think we're frankly looking at, will remove some of that financial penalty and lock-in effect. And that's why we do see actives going up a little bit as rates start to go down, and that should unlock the transactions. But this is a far cry from being supportive of an environment where prices are going to plummet, where really only 15 to 30% of folks are going to be in a position to move. And so I think inventory is going to be tight for the foreseeable future. If you look at the number of new listings that we put onto the MLS last month, it was like the weakest we've seen in the last 3 years, which was an all-time low for inventory, right? So again, this just kind of illustrates how loath sellers are to walk away from these hyper low rate loans and why supply is just not going to be there to support these big price reductions that your brother-in-law is telling you about, right? So even, again, demand has gone down, but supply has gone down even more, meaning that the market remains tight and prices continue to rise. In fact, December was the sixth month in a row where prices are going up, not down. And so if this was just purely a function of demand, you would see the opposite, right? That sales would be going down and prices would also be going down because no one wants to buy. The fact that sales are going down and prices are going up shows us how much of this is driven by a lack of available inventory, and why even as rates, are still double what they were a few years ago, prices continue to rise, and that's because demand is still way higher than available supply. We can see that the kind of injection of these higher rates has created some systemic risk by reducing affordability. So if you look at where actual home prices are now and you compare it to what's kind of an affordable home price, where prices should be if we just had the middle household buying the middle house at current interest rates, we should see a home price of about 560 to 600,000, somewhere in there. In other words, home prices aren't purely supported by fundamentals right now. But we can think through, what does a worst case scenario look like if home prices were to tank and the bottom fell out of the market? We can find that floor is that affordable price. If prices go below 560, they would be so affordable and such good deals that you would see all the investors kind of pile into the market and push prices back up through that demand mechanism. That's exactly what happened back in 2008. In fact, if you look at the blue line, it dipped below that affordable level. We had a bunch of people come in and gobble up all the single family units. And by 2013, prices have been pushed right back up to that kind of affordable level once again. But even if I'm wrong and my forecast sucks and prices do tank, it equates to about a 20% decline in home prices to get us back to that affordable home price level. Why is that relevant? Going to materialize in a bunch of REO inventory. And I see that my internet might be having problems, so I apologize if that's the case. But ultimately, even in an all bets are off economy, it's not going to result in a bunch of foreclosures. If you look at where we were back in 2013, you had about 30% of the market that had less than 20% home equity. And this was even after a bunch of people had already foreclosed. All those 0% down 5-1 option arm people had already foreclosed, and yet we still had a third of the market with, basically no home equity. If you look at where we're at now, 95% of the market has at least 20% home equity. 90% of folks out there have at least 30% home equity. So even if that worst case scenario actually happened and prices fell from where they actually are down to that level that's just purely driven by fundamentals, it would mean that you still had 9 out of 10 homeowners with equity, and you don't foreclose on a house that's worth more than you owe on it, even if you lose your job, right? So this is kind of like strike one for your brother-in-law's foreclosure crisis, is you don't walk away from a house that's worth more than you owe on it, particularly if you've got, a sweetheart mortgage rate that makes your mortgage a lot cheaper than what your rent would be at an equivalent home. We also see that barely anybody joined my ex and like buying boats and RVs out of home equity, even though prices were way higher this time around. The amount of HELOC and home equity loans was way, way smaller. So most of this equity still lives in the house. Even in a worst case scenario, you're not going to have a bunch of upside down homeowners that are looking to throw the keys back to the bank, meaning that there's not going to be a bunch of price declines because of a flood of REO inventory. You also don't have this kind of ticking time bomb element to the mortgage market. If you go back to 2013, and again, we'd already gotten rid of a lot of these bad loans by then, but unfortunately, this is as early as the National Mortgage Database goes. But even back in 2013, you had 1 out of 5 homeowners with a 5-1 option arm, negative AM loan. Their payment could go up overnight and that loan product blows up in their face. And now They have no equity because they put 0% down, and their mortgage just went up by $2,000 a month overnight. That's a kind of recipe for walking away from that property. This time around, you have less than 5% of folks in an adjustable rate mortgage, meaning 95% of folks are in either a fixed rate 30 or even a 15-year fixed rate loan at, again, the lowest interest rates of all time. That's kind of strike two, right? That we don't have that kind of ticking time bomb element for bad mortgages to potentially go belly up on us, meaning, again, no foreclosures. And then strike three for your brother-in-law's email newsletter is the fact that 98% of people in California are still paying their mortgages on time. They are very much prioritizing staying current on these 3% mortgages. And so that's really, the end of the story as far as I'm concerned for the outlook on foreclosures, because you have home equity with the lowest rate, locked in, fixed rate loan of all time, and everybody's paying their mortgage on time. And so you don't throw the keys back on a house that the bank isn't even hounding you because you're current on your payments that's worth more than you owe on it. You've got this sweetheart mortgage rate. So I do not expect prices to do anything but continue to rise this year because of the fundamental Econ 101, kind of framework of just lack of supply and demand that should only improve as rates continue to come down. So what does that mean for the buyers and sellers? Buyers that are employed and renting and sitting around on the sidelines thinking prices are going to fall are missing the boat. Look at active inventory. It's lower now than it was when the economy was in total shutdown back in early 2020. When inventory is this tight, prices don't come down. You're going to be paying more money for the same house by waiting until next year. And you're probably going to be paying rates that aren't that much different than what you're seeing currently. And guess what? If I'm wrong and rates go down to 3%, that costs you nothing. You can go out and refi, take advantage, Bob's your uncle, and you're sitting pretty. And so again, supply is the key to prices, and supply is not going up enough to make homes cheaper in California. It's really as simple as that. What do we need to tell home sellers? We need them to understand that we're not in a 3% rate environment. So people like my ex that think they're making all this money and already mentally have it spent and are reluctant to negotiate when the home's been sitting for a while or you're not getting offers, they need to understand that demand now is still more depressed than at any time it's been, going back way before the pandemic. It's still a great time to sell your home. Prices are going up. Inventory is still very tight, but we've got to be strategic, and there's just fewer buyers at every price point. So it's taken a little bit longer to sell. We're not seeing as much go over list and all of that. So we just need to be smart about it. And you need to have a really good realtor that knows how to show it, knows what investments to make, what's a waste of money, how to stage it, how to market it, and all of that kind of stuff, because we're not in that kind of white hot environment that we were in. Again, few years ago, you could put it on Monday and have it go pending on Wednesday. Now it's looking more like a month to go pending. And that's just, again, a symptom of this reduction in demand. Still a great time. I think you're going to do really well, but it's just a different market than it was. You have about a third of sellers that have actually reduced price. So if you draw a line in the sand and say, I'm getting that boat no matter what, you just have to understand that other sellers are competing for this business, and we're competing against them in ways that we never had to when rates were at 3%. So if I don't want to budge and it's been sitting a long time and I don't want to do the reduction, I just have to get more comfortable because other sellers are doing those reductions, doing the 3-2-1 or the 2-1 rate buy downs and whatever they can to get it moved. And so you, again, just have to have a little bit more of an experienced agent helping you really navigate and understand which way the winds are blowing. If you have it looking good and staged and all of that stuff and priced strategically, you're still seeing about a third of homes close above list. It's just not, again, that 3% rate when almost everything was going above list price. So just bringing buyers and sellers back down to earth, reminding buyers, those kind of gainfully employed high-income renters that, home ownership is a long-term game. If you look at net worth in the United States, AKA wealth, it's no surprise that renters last year were no better off than they were 30, 40 years ago. When you rent, you don't end up accumulating any net worth. That's what home ownership is all about, right? If I was a realtor, I would have this printed out in my back pocket, and every single employed renter I knew, I'd bust this out and I would say, do you want to be blue or do you want to be yellow? Like that is what home ownership is all about. Renters end up just consuming more, driving nicer cars, living in fancier apartments, going on fancier trips, or flying first class, or what have you. They don't end up getting any better off. And even with the downturn in 2008, net worth for homeowners immediately started going back up thereafter. And that's the only reason why the net worth for all families is 192,000, is because we have so many owners in the pot. You take them out and you'd see that America would be a very, very poor country. That's what home ownership's all about, not about timing the market like your brother-in-law says. And for that reason, in and of itself, I think we can be optimistic, because again, there's a lot of people that can afford it that are doing themselves a disservice by waiting on the sidelines. So if you look at our forecast, it's not a catastrophe. Economy's still going to grow. Unemployment's still going to be low, but consumers are going to spend less. We're going to have less open positions, a less hot labor market, and that will help inflation to get back down to that 2.5% mark by the end of the year. That will help rates fall, and you can see we have an average of about 6.5% for the year. So starting out around 7, ending up probably in that low 6% range. That will help demand, but more importantly, help supply, which is why we have sales going up by about 25%, only to 325,000. So again, not time to celebrate or pop the champagne corks, but about 60,000 more units than we did last year, and prices that will probably continue to rise as demand responds much more quickly than supply, because so many of those folks are locked in very low. So I think, again, cleaving to consumers, really stepping up our game and recognizing that they need us more than ever, but that means we've got to really bring it in terms of being that trusted advisor, market expert, showing them the data, overcoming that brother-in-law effect, and evangelizing for home ownership. And I think those of us that do that, sky's the limit. You already survived the lowest year, looking back over the last 10 years, but it's still going to be a market share game. So just keep your nose to the grindstone, and sky's the limit. And with that, I would say thank you so much to Jeanette for the opportunity to speak with you, and thank you all for your time and attention today. And I know
Jordan, yeah,
yeah,
no, that was great information. I'm sure everyone that came today is very thrilled to hear what you have shared with us. And thank you for letting us record it. And we will be placing it in our Today Matters and our YouTube. You're the
great.
best.
I really appreciate it. And I'll make sure I send you a copy of these slides for your